All right. What is going on, everybody? It's a rather unusual time that we are experiencing geopolitically right now. What is going on, everybody? Oh, I can hear myself. Let's see. We're good now? Let's see if I can hear myself. Hold on a second. All right. All right. I think we're good now. So anyway, hope everyone is out there being safe and that everyone's families are doing well. Gotta be so grateful here, being in the United States, to have a country like we do. And with that said, there's a little bit that's kind of going on in the markets, I'm sure, as you can see, as a result of what is going on around the world. And actually, before further ado, I'm also going to go on Instagram Live for a minute. Actually, you know what? Do that another time. I just want to go ahead and get started with this. I think we've got a lot to talk about. So if you got money that's in the stock market right now, whether you are, and we're going to talk about equity stocks. We're going to talk about stocks here in a few minutes. But if you have money that's in the stock market, you make sure that you are comfortable leaving it there for years to come. You make sure, I've said this in prior webinars, to have a long-term perspective when dealing with stocks. Okay, so and when I say a long-term perspective, the reason for that is because of events that happen like what we're dealing with right now. Okay, we have a terrorist group, Hamas, that is taking control of Palestine. There's innocent Palestinians and innocent Israelis are getting killed as well, and it's terrible. Both sides look at it. Terrorism is just absolutely horrendous. However, it has a trickle down effect, right? So although the companies that we're going to be purchasing for ourselves in our portfolio aren't necessarily located in Palestine or Israel or something like that, they are indirectly affected, our companies here. And so what I mean by that is so if I'm reading correct, I'm reading right here. So the 10-year note yield is down 10 basis points. Okay. That has to do with the banks. We'll definitely get into that another time, what the 10-year note yield means. So what happens is the various banks are dealing with various countries around the world, and what's going on, moves are being driven by safe haven activity related to Israel-Hamas conflict escalating after Israel warned 1.1 million people in Gaza to evacuate ahead of expected counteroffensive. So honestly, I don't know the particulars of how it's all affected, but it's not my job to know all those intricacies. However, because of that, we do have some Arab countries that rely on those areas as well for their resources. Oil prices are moving higher in response, and so that has a trickle down effect into the United States. So just a little something there. If you've got money in the market, the reason why that we leave it long term is because of instances that happen like today, or I'm sorry, not today, like this past couple of weeks, right? Or another 2008, right? So for people that took their money out of the market at the low, I'm like, oh, we're gonna go get back in at when it comes back down. Well, if they wanted to go back in when it goes down, they would have put it in, kind of recently, right? Almost 20 years later. I'm sorry, almost a little more than 10 years later. So it's very interesting. So the psychology of how people invest is very, very interesting. So without further ado, let's get into some stocks. So stocks have a couple of different names. So stock, equity, security, they're all the same thing. They're all stocks. They just some people prefer using the word equity over stock. Security is more, if someone just says, oh, they've got multiple securities in there, a security could also be like an ETF or a mutual fund. It doesn't necessarily have to be a stock, but an equity is 100% a stock. And so what is a stock? And that's how it's, some people don't actually know what it is, and they have them, and that's okay. They don't teach us about these things naturally. So it quite literally means a security that represents a proportional ownership of the issuing company. So you buy an Apple share, one Apple share, you own, that amount of shares, how much you own of Apple as a company, because they're public, it's publicly owned, right? It's not privately held. So, and a unit of a stock is called a share. So when someone's like, oh, okay, how many shares do you have? I have, 1 share of Apple. And the price per share is what the value of that share is, the price of the stock on that day. And stocks values trade, or stocks values fluctuate throughout the day. Okay, and some more than others, just depending on how volatile they are, and some are very stable, some are going to be more aggressive. So it just depends on the company. For example, Kimberly-Clark, right? So Kimberly-Clark makes a lot of household items that are going to be people are going to purchase throughout the year, regardless of what the economy is doing. It's going to be a very stable, secure stock. Companies like maybe Tesla. Okay, I think we can all agree Tesla's a little bit more volatile. It's up and down. It's in the news. It's in this, and that. So that's what has to do with the price per share. So why do corporations give you the opportunity to own a stock? Well, when you purchase stock, it enables the company to raise funds to operate their day-to-day business operations. That's all it is, really. They're giving you an opportunity to own a portion of the company, and in turn, they get to use that money to grow the company. So there's a couple of different kinds of stock, and the most commonly spoken one is quite literally called common stock, which you would buy on your trading platform or with your broker. And when you own common stock, you actually have the right to vote. So you'll get it's called a proxy, okay? You'll get it in the mail, or you'll get it in the email about it, and you get to vote on the board of directors. I'm pretty sure there's a few other matters that you get to vote on, but I know very few people who do vote, maybe 1 or 2. I personally, I don't vote. You don't have to. You have the right to vote. You don't have to. And also, as a common stockholder, you have the right to a dividend. And I'll get into dividends in a minute. But the next stock I'm going to go over is a preferred stock. So preferred shares, they're a little bit more difficult to purchase. Okay, there's fewer of them offered. You would need to go to a broker in order to buy them. Like you can't just go on to like E-Trade or what have you, and you can't go onto E-Trade and do that. You have to go through a broker, and you do not have any voting rights when you own preferred shares. However, preferred means preferential treatment. You get your dividends before common shareholders. Nice little perk. And so if companies want to raise more money for their operations, they're going to issue more common stock, give people more opportunities to buy them. And so before, when I was talking about what's the right to a dividend, or what is a dividend? So a dividend is pretty much a company's way of rewarding you for being a shareholder. Okay, for example, Apple gives a dividend of 0.5%. Not that much. It's a little something. Okay. A company like Sunoco, Sunoco Gas Company. If you've filled up at a Sunoco station before, they give a dividend of 6.59% as of right now. And those companies have the right to change their dividend at any time, or they can take it away all in total and give it back at another time. So a reason why a company would take away their dividend is to, instead of distributing money back out to shareholders, if it's a struggling company, which I wouldn't suggest you go invest in that one anyway, they'll reclaim their dividend and use the money that they would have given to shareholders to regrow their operations. Okay. And not all stocks give a dividend. So Amazon does not, Tesla does not. Instead of giving a dividend, they reinvest the money back into the company to grow it. Okay. And that is why those companies like Tesla and Amazon are just called growth stocks. They don't give a dividend. Ones that do give a dividend are usually called value stocks. And something that I do as a private wealth manager, something our team does, is we create portfolios that have these certain types of stocks in there to achieve a certain objective. So, for example, a dividend portfolio, right? So if somebody is in retirement and they want to maintain a certain level of income throughout the year, they're going to have the way that we pick our dividend stocks. Blue chip companies, meaning they're very good companies, household names for the most part, ability to meet their earnings every quarter, strong leadership, they're fundamentally and technically strong, and that they either maintain or raise their dividend throughout the year. And if they don't meet that criteria, we remove it from the portfolio and swap it out with another one. Okay. The thing with dividend portfolios, so you're going to have many different stocks with many different dividends in there. Okay, so so you might have some that are paying like Sunoco paying 6.5. Okay, you might have others like Verizon that are paying 7% dividends. So dividend portfolios like that are going to have an average at the bottom. The average might be anywhere from 4 to 4.5%, which is great. Growth portfolios are going to be very similar, however, just companies that give maybe a very small dividend or no dividend at all. And the purpose of those that's going to grow a lot quicker than a dividend portfolio from a share price perspective. Okay. So having companies that all they're doing is reinvesting what would be dividends back in the company, making the companies bigger. Over the course of many years, they're going to be very well off in that growth portfolio. Dividend portfolios, going back to those, what you can do with dividends is that you can either take the dividend as cash, or you can reinvest it for more shares. Let's say you're getting, just keep it easy, $100 a year in dividends, and it's a $25 stock. I would have to be a really big dividend. Let's just keep it that way, okay? So you'd get 4 extra shares throughout the year just for having a dividend and reinvesting it. And over the years, your portfolio size is going to grow and grow because you're reinvesting your dividends at many different share prices. It's a fantastic way to grow a portfolio. We do that for many of our clients. So next we're going to go over some buzzwords here. And I'm sure if you've ever watched CNBC or on TikTok, Instagram, you've heard earnings. Okay, what is that? So earnings, quite simply, is the profit that a company produces in a specific period, which in our case is quarterly. Quarterly is every 3 months. There are 4 quarters in the year: Q1, Q2, Q3, Q4. And these companies, they're public companies, they have to announce their earnings. They typically report every January, April, July, and October. So right now we're starting to see some earnings come through. And recently, I think just the banks, so we had some financial services sector came through on their earnings. So earnings is a whole another conversation. From a reporting standpoint to a guidance standpoint, there's so many other different terms that I would love to have another webinar about. We'll take a deeper dive on earnings another time. There's a ton to go over with that. But trading stocks based on earnings is not necessarily a good strategy. And again, I will go over this in more in depth on the earnings call. But for example, okay, I just said that some banks had earnings, announced their earnings for this quarter for October, since we're in October, and they had better than expected earnings. However, despite everything that's going on geopolitically right now, they're down in share price today. So that just goes to show you that external factors are going to be a determination of the stock price as well. There are instances where earnings directly affect the share price. If usually what happens is a company will have their earnings call publicly after market close on whatever day, and after market close, the market closes at 4. Sometimes they'll have their earnings call at 5, announcing what their earnings were. You can look on the your Apple stocks or on your CNBC app, wherever you have all your watch list, and you can see the extended market hours. How the earnings call will affect the share price in the aftermarket hours. So, and then the next morning when the market opens, it's going to be probably something similar. Meta had really great earnings a little while ago, and their share price jumped tremendously. And with their introduction, they announced that they're going to be doing all this AI and this and that. It was great. The share price jumped dramatically. But again, we'll go in that direction for another webinar. The last thing I want to talk about, buzzword again, stock splits. Okay, what is a stock split? So literally in a stock split, nothing happens to your proportionate ownership. Speak today. So we remember Amazon had a 20-for-1 stock split, I don't know, maybe 7 or 8 months ago. So what that means, so just to put it into terms that are a little easier to understand, let's say you had a pizza, okay? You have one pizza. So a 20-for-1, let's just say 5-for-1 stock split, pizza split, you're going to cut it into 5 slices, okay? So we don't just magically have 5 pizzas now. That would be awesome. But we have 5 pieces of one pizza. So when you have a 5-for-1 stock split, for every 1 share that you have now you have 5. Amazon did a 20-for-1 split. Every 1 share of Amazon that you had, now you have 20. If you had 2 shares of Amazon, now you have 40. What happens is that the share price will decrease on a stock split. Okay, so even though you have more shares, it doesn't mean magically you've got way more price or the stock price because of it and gains, it just means that the amount of shares that you have is now increased, but the value of those shares has gone down. Now, why would a company want to do a stock split? For a couple of reasons. One, they think that their share price is getting maybe too big. The barrier to entry is going to be lower. Let's say it's $1,000 per share of stock. Okay, I don't necessarily be purchasing several shares of that stock. If they do a split, now the barrier to entry for that stock is lower. Now I'm able to go in and buy a bunch of them. Okay, it's more accessible for individuals who don't necessarily want to pay that much, which is a majority of the world, right? So that's what that's all about. Why split? Just makes the barrier to entry much lower. And on the flip side of that, a reverse split. Oh, I'm sorry, I forgot to mention also, you can have a mandatory split too. If the SEC feels that your share price is growing quicker than what they feel is possible for the company to maintain or manage, they certainly don't want a huge drastic swing in the market, especially if it's a large company. One large company in the S&P 500 can throw off the rest of the index, which is shocking. The SEC will go in and mandatorily split the stock. And for us as shareholders, that doesn't mean anything really. Okay, we just have more or less money. Now there's a reverse split as well. So let's say you have five. So let's say you have 5 shares. Now you have 1. Less shares, higher price per share. That's what a stock split is. Very simply. So now you know. So I hope you all found this helpful. See if we have any questions in the comments section. I do not see any questions in here. Well, if there are any questions that you guys have, please feel free to reach out on Instagram or on TradeZing. I'm at Wes on TradeZing and at the Wes Gottesman on Instagram. Thank you so much for your time, and I appreciate you guys tuning in. I hope you found this helpful. The next one, we're going to be diving in on bonds.